Picture two people, same age, same salary, both working 40 plus hours a week, paying taxes, contributing to their 401k. On paper, identical. But here's what's wild. One of them is quietly building real, compounding wealth right now, and the other one is about to get blindsided by the most significant economic shift in a decade. What's the difference between them? One listened to what Goldman Sachs actually said in their 2026 outlook. The other one saw the headline, assumed it was just banker speak, and kept doing what they'd always done. Here's the thing. When Goldman Sachs releases a market warning, the financial media does two things. They either completely sensationalize it crash incoming, or they strip out all the nuance and make it sound like everything is fine. Neither is accurate, and neither actually helps you. So today, we're going to decode what Goldman Sachs is really saying in their 2026 outlook. Not the headlines, not the spin, the actual signal buried inside the report and what it means for your money, your investments, and your financial future. Stay with me because this one is important. Let's start with an uncomfortable truth. Most people interact with major financial reports the same way they interact with their horoscope. They skim it, pick the part that feels relevant to them, and move on. And then they wonder why their financial decisions feel reactive, emotional, and frankly, exhausting. Here's what's actually happening in your brain when you hear Goldman Sachs issues 2026 warning. Your threat detection system fires. Cortisol spikes. You want either to panic sell everything or to completely tune out because it feels too overwhelming. This is called the amygdala hijack, and financial institutions, whether they intend to or not, trigger this constantly. But here's the hidden cost of operating in that panic or ignore mode. You miss the actual intelligence inside these reports. Goldman Sachs employs some of the most well-resourced economic analysts on the planet. They're not always right, nobody is, but they are using data, macro models, and global positioning to paint a picture of what they expect the next 12 to 24 months to look like. And that picture has very specific implications for your portfolio. Let's talk about what I call the three misreading traps that most everyday investors fall into when a report like this comes out. Trap number one, the confirmation bias filter. You read the Goldman report looking for evidence of what you already believe. If you think a crash is coming, you'll find those sentences. If you're bullish, you'll find those. The problem is the report is designed to be comprehensive. It contains both. Picking one side doesn't give you the full picture. Trap number two, the single metric obsession. Media loves to grab one number. Goldman projects S&P at X by year end and treat it like prophecy. In reality, these forecasts are probability-weighted scenarios. There's always a bull case, a base case, and a bear case. Latching onto one number strips away all the context that actually matters. Trap number three, assuming it doesn't apply to you. I'm not a hedge fund, I'm just trying to save for retirement. I hear this constantly, but Goldman's 2026 warning touches on exactly the sectors, asset classes, and economic dynamics that affect everyday investors, your index funds, your bond allocation, your cash sitting in a high-yield savings account. This absolutely applies to you. The deeper psychological trap here is something called optimism bias, the tendency to believe that negative outcomes are more likely to happen to other people than to us. It's human, it's normal, and it is financially dangerous in a year like 2026, where the macro environment is more complex than it's been in years. So let's put down the headlines, quiet the noise, and actually look at what Goldman is saying, and more importantly, what you should do about it. I've broken the Goldman Sachs 2026 outlook down into 5 core signals. This is what I'm calling the 5 signal decoder. For each signal, I'll tell you what Goldman is actually pointing to, why it matters, and what the smart money move is for you, the everyday investor right now. Goldman's base case for 2026 is that the US economy achieves something economists have historically been skeptical of, a soft landing. Inflation cools, employment stays relatively strong, and a recession is avoided. That sounds great, right? Here's the catch. Goldman buries 3 paragraphs in. A soft landing is priced in, meaning the stock market has already done much of the work of celebrating this outcome. If you're sitting on the sideline waiting for the all-clear signal to invest, that signal already rang, you may have missed a chunk of the entry window. The actionable move here is not to panic buy everything right now. It's to shift from should I be in the market to how am I positioned within the market. Goldman is signaling that index-wide gains will likely be more modest in 2026, and that sector selection matters more than it has in recent years. Specifically, cyclical sectors that benefit from a no-recession environment, industrials, financials, select consumer discretionary look more attractive than they did when recession fears were peaking. Defensive holdings like utilities may underperform. The question isn't market in or market out. The question is, what kind of market exposure do you have? Goldman projects continued rate cuts from the Federal Reserve heading into 2026. On the surface, this feels like great news: cheaper borrowing, potential housing market activity, relief for anyone carrying high interest debt. But here's the nuance that gets lost. Rate cuts don't instantly translate into the rates you experience day to day. Mortgage rates, for example, are tied more closely to the 1-0-year Treasury yield than to the Fed funds rate. And Goldman's outlook for long-term yields is more mixed. They're not projecting a dramatic drop in the 1-0 year. What this means practically: if you're waiting for your high-yield savings account rate to stay elevated, it won't. Those rates are directly tied to the Fed, and they will fall as the Fed cuts. If you have cash parked in a high-yield savings account or money market fund right now, this is your signal to start thinking about where that cash goes as yields compress. Here's what Goldman's positioning implies for you. This is a window to ladder into intermediate-term bonds or bond funds before rates drop further, locking in relatively attractive yields before they're gone. It's also a window to refinance variable rate debt if you haven't already. And if you've been sitting on the sidelines waiting to buy a home, know that the mortgage rate relief you're waiting for may take longer than the Fed headlines suggest. This is the signal that most people gloss over because it's uncomfortable. Goldman's 2026 outlook notes that U.S. equity valuations, especially in mega-cap tech, remain elevated relative to historical averages. This doesn't mean crash. It means the easy gains may already be in your rearview mirror, and your risk may be higher than you think it is. Here's the concentration risk problem that Goldman is quietly raising a flag about. If you own a broad S&P 500 index fund, which is great, by the way, you may feel diversified, but when the top 10 holdings make up a disproportionate share of that index, and those 10 companies are all in a similar sector and facing similar regulatory and macro headwinds, you are more concentrated than the word index fund implies. The actionable response is not to panic sell your index funds. It's to look at whether your overall equity exposure has sufficient diversification across geographies and market caps. Goldman has been constructive on international equities, particularly Europe, and select emerging markets where valuations are lower and the macro setup is different. Adding even a modest allocation to international developed or emerging market funds can meaningfully change your concentration profile. One of the clearest signals in Goldman's 2026 outlook is that the AI investment cycle is not over, but it is maturing. The indiscriminate buy anything with AI in the name phase has passed. We're moving into a phase where the market rewards companies that can demonstrate actual revenue and margin expansion from AI investments, not just the promise of it. For you as an investor, this has a very specific implication. Owning broad tech exposure is not the same as having smart AI exposure. There are companies that have built the infrastructure, the chips, the data centers, the cloud platforms, and there are companies that are now paying for that infrastructure and need to prove the return on investment. These two groups will perform very differently in 2026. Goldman's positioning suggests the infrastructure layer, semiconductors, cloud providers may face a digestion period, while enterprise software companies that show real AI-driven productivity gains become more interesting. This doesn't mean dumping your tech holdings. It means understanding what you own within tech and why. Practically, if you're a buy and hold index investor, this is largely handled for you as the market reprices these companies. But if you're managing sector ETFs or individual stocks, 2026 demands more discernment inside tech than the previous 2 years did. This is the signal that almost nobody is talking about in the mainstream financial media, but Goldman's analysts are clearly watching it closely. The trajectory of the US dollar and evolving global trade dynamics heading into 2026. A moderately weaker dollar, which Goldman sees as a plausible scenario given rate differentials narrowing globally, actually benefits US multinational companies as their overseas earnings translate back into more dollars. It also benefits international investments in your portfolio, since you're getting both the return of the foreign asset and a favorable currency conversion. But the trade dynamics piece is less comfortable. Ongoing geopolitical tensions, supply chain repositioning, and policy uncertainty around tariffs create a layer of risk for globally exposed companies that isn't fully priced in. Goldman flags this as a tail risk, not their base case, but a scenario worth hedging against. The actionable move here: make sure you have some real asset exposure in your portfolio. Commodities, real estate investment trusts, treasury inflation protected securities, these tend to hold value better when trade disruptions or currency volatility spike. Even a modest 5 to 10% allocation to real assets is a meaningful hedge against the scenario Goldman is quietly preparing for. I know what some of you are thinking. Alicia, Goldman Sachs has been wrong before. Why should I listen to them? That is a completely fair point, and it's actually central to how you should use this information. No forecast, Goldman's or anyone else's, should be treated as a certainty. What Goldman's report gives you is a probabilistic framework. Here are the scenarios with the highest likelihood. Here are the tail risks. Here are the asset classes that fare well across multiple scenarios. You're not betting on Goldman being right. You're using their research to stress test your existing portfolio. Second objection: I don't have enough money to worry about sector allocation and international diversification. Actually, if you have a 401k or IRA with even basic fund options, most of these moves are available to you through low-cost ETFs and target date fund selections. You don't need to be a high net worth investor to act on any of what I've described today. You need a Roth IRA and a Fidelity or Vanguard account. That's it. Third objection: the market is unpredictable, and even Goldman can't tell me what's going to happen. 100% correct. The goal is not prediction. The goal is positioning. There is a difference between trying to time the market perfectly, which nobody does consistently, and building a portfolio that is resilient across multiple plausible 2026 scenarios. That's entirely achievable, and it's what separates the investor who builds real wealth from the one who simply hopes for the best. Finally, your financial journey is personal. Your risk tolerance, your timeline, your income situation, all of this shapes how aggressively or conservatively you act on any of these signals. The framework I've given you today is a starting point, not a prescription. Use it to have a more informed conversation with yourself, and ideally with a fee-only financial advisor who can contextualize it for your specific situation. Let's bring it all together. Goldman Sachs' 2026 warning is not doom and gloom, and it's not a green light to throw money at the market carelessly. It is a nuanced, data-rich signal that, if you know how to read, it tells you exactly where opportunity and risk are positioned for the year ahead. The soft landing is real, but the easy gains may be behind us. Rate cuts are coming, but your cash strategy needs to adapt now. Equities are not cheap, and concentration risk is quietly building. AI is still a generational theme, but it's getting selective, and global trade dynamics are a quiet risk worth hedging. These 5 signals together paint a picture of a 2026 that rewards thoughtful, positioned investors and punishes complacency. The question is, which investor do you want to be? If you found this breakdown useful, hit subscribe. I break down complex financial reports like this every week, so you don't have to. Drop a comment below telling me which of the 5 signals surprised you the most. And share this video with one person in your life who needs to hear it. It genuinely might change how they handle their money this year. I'll see you in the next one.